don't be fooled into risk goes away the longer that I'm in the market. Yes, your 100 went to 600 or 800, but it's the 1 year risk that people can't handle. I've been doing this for 35 years. I know people can't handle down 35, 40%.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
This is John Smallwood back on Money Isn't. And today I have a concept that I want to be talking about. And there's something in financial planning that bothers me from the way we think about money, right? And it has to do with time in the market and the volatility of a market. And what people are typically saying is that if I look at 1 year volatility, I'm recording a screen here from JP Morgan, right? That talks about, you have a stock portfolio. I'm just going to focus on the green line, which is the stock portfolio, right? The 1 year volatility on this, the market could be up 52%, down 37. If I'm in the market for 5 years, I can be up 29%, down 2, somewhere in there. If I'm in the market for 10-year rolling, it's that same, it's 20% to 1%. If I'm in it for 20 years, they're saying floor of about 6, upside of about 18. And that's sort of like, you start thinking about it. I take $100,000 and I invest it, and it grows to $1 million. I'm just using that as an example. I don't have a time frame. I'm not looking at it, but I'm in the S&P 500. Has my 1 year volatility changed? Or is it still going to be the same 1 year volatility? Can I be up 52% or could I be down 37%? And the answer to the question is, if I'm in the same bucket, yes. But when I started with 100, if I was down 37%, I think I may not be able to handle that, right? So I got to look at that. But I grew it to $1 million, and now it's down 37 or 50% because this is 1 year numbers, right? And if you remember the 08, 09, 08, it was down 37%. 09, it was down 25% into March, which, collectively you were down 52, 53%. The question is, if I'm close to retirement and I have $1 million that falls 40, 50%, that is detrimental. So yes, my 100 is still worth 400,000 or 500,000. So the time of the money in the market is fine, but the 1 year volatility has not changed. It never goes away. Matter of fact, it becomes greater the longer that you're in, that you're going to have one of those 50%, drawdown periods. Like this is 1 year numbers versus two year numbers, right? And then the question is, do I diversify, right? So when I diversify and I say, if I put all my money in bonds, I still, according to this, from 1950 to 2023, and the index that they're using for the bond market is Bloomberg aggregate bond, right? And they're saying up 34, down 20 for a 1 year, bonds up 33, down 13, which we experienced in 2022. But then I'm at this 11 to 5, but the bonds only created $279,000 versus $868,000. And then you look at it from a 60-40 standpoint, and the 60-40 created $600,000. But I still have a 1 year volatility of up 34, down 20. The problem is the psychology of the investor. If I'm down 50% because the math is easy. So $1 million goes to 500,000. To get back to even, I got to make 100%. Right? It's not, I got to make 50%. I got to make 100% to get back to break even. So now, if I'm withdrawing money from that portfolio and I'm selling shares, just assume I'm selling shares for a second, when the portfolio is worth $1 million, let's say I'm withdrawing 2 shares to get my income. Now it's down 50% to get the same income. I got to withdraw 4 shares. And now when the market recovers, I have 2 less shares than I should have had, and the portfolio doesn't recover. So risk, and there was a book years ago that I think the gentleman's name was Ed Easterling. My father loved the book, and it was about risk, and his position is risk doesn't go away. And he quoted the book. My father quoted the book by saying, risk is not like fertilizer. I do not spread it onto my portfolio and magically it grows. I could put too much fertilizer and kill the portfolio. Too much risk. Smallwood Wealth Management is the lead sponsor of this podcast. You have an opportunity to have a free, no obligation conversation with one of our qualified advisors. Go to smallwoodwealth.com, schedule a call, or call us at 800-797-1000 and get on our calendars. So what I want you to take away from this conversation is risk does not go away with time in the market. The 1-year volatilities are always there. The question is, do I have other buffers and other things in place that when it does happen, I don't have to panic, right? Because we want you to get to the 800 versus the 600 versus the 300. But it's like, how is it that you're doing? Are you taking money and repositioning it? Are you creating a defensive structure? And when you simulate returns, and they say the Monte Carlo simulation is going to get you 6% over the time frame, and your expected outcome is you'll have somewhere between 1 million and 3 million, and you'll have money at 85, is creating a smooth ride. Nobody gets a smooth ride, meaning you get volatility adjusted returns. You don't get the average of 1,000 different markets. You get the market, and whatever the market is in that year, the following quarter, the following month, you get those returns. And you don't know what those returns are because past performance is no guarantee of future success, right? The market will not play out the same way. The predictions based on this event, the market should do this, and it doesn't happen, right? Or, oh, we didn't see this black swan event coming. We didn't understand the credit crisis. We didn't understand, .com bubble. We didn't understand. Sure, we did afterwards, right? But the best philosophy that you're going to have is, what are your goals in the plan? What's the role of your money, of this money? How do you have other things buffered around it? What's your total macro plan? And people that have a plan and understand that, hey, market dropped 50%, it's not a reason to go and run away. It's like, oh, I got cash, let me deploy it, right? Opportunity, market's down 30-something%, that's opportunity. It's bad for your old money, but it's also an opportunity. But the plan is people, the emotional roller coaster, I've done this over different podcasts, we've shown the charts. When the markets are running up, when the market's up 52%, everybody wants to climb in. It's the most dangerous point. The odds of it coming down on the back end of a great run up are far greater than after a long sustained downturn when everybody's despondent, and it's different this time and corporations are having problems, right? I mean, this is a plan. You need to create a plan. You need to understand that that's going to happen. How do I reduce the volatility? Is it with bonds? Is it with put options? Is it with annuities? Is it with life insurance? Is it with cash in the bank? Is it with real estate? What is your diversification strategy? It's unique and different for everybody, okay? But you need to understand, if I'm sitting on a massive amount of money in the stock market and I don't have defense and volatility, and the markets do drop 50%, what's my planned reaction? How am I going to react to that? Do I have contingency? Do I have backup? Do I have the potential? Like, there's so many things that I want to bring into this, but I want it to be short and I want it to be sweet today. And I want it to be as colorful with what I was saying to realize that don't be fooled into risk goes away the longer that I'm in the market. Yes, your 100 went to 600 or 800, but it's the 1 year risk that people can't handle. I've been doing this for 35 years. I know people can't handle down 35, 40%, the human being. But if my collective portfolio is down because I have all these other backup and redundancies is down 8%, I can handle that. And to get back to even, I only have to make about 13. That's a lot easier. We have a chart that we can show that too. I just didn't want to bore us with all kinds of charts. Now, if you're listening to this podcast and you're still here, you understand this. You want more information, right? We have a book. It's called It's Your Wealth, Keep It. It's on Amazon. It got #1 best-selling in, I believe, retirement planning and #2 in wealth management, or vice versa. I always get it wrong. Who cares? It's a good book because it talks about the psychology of how to build a full macro plan. We call it beautiful balance, right? You have to have balance. If your plan is risk on, all risk on, it may or may not work, right? But ultimately, my dad used to say, money isn't everything, but without it, you can't get a date. Retirement, money's not everything, but in retirement without it, it's not good. It's just not good. It's not as enjoyable as what you thought. You work for 40 years. You want to make sure that you enjoy what you're doing. This was awesome. I want you to take action. I want you to build a plan. I want you to understand you have market risk. You have tax risk. You have credit risk. You have liquidity risk. You have real estate risk. You have, I'm renting an apartment. What's my risk? The rent renews and the guy says, you're paying $2,000 and current rates are $3,500. I'm going to raise you to $2,800. That's a risk. You have health risk. You have inflation risk. You have planned obsolescence risk. You have risk everywhere. Do you understand where your risk is? Do you really understand? We'd like to help you figure that out. If not, find somebody that can, because it's really important that you get it right.